What's up, everyone? It's Karthik at MoneyVest. Markets absolutely getting crushed. Over $600 billion worth of market cap just erased in the markets today. A lot of that sell-off, of course, coming from Magnificent Seven. Looks like Santa has left the town. And December has actually been a very, very weird month because we were down on the day, we're up on the week, but we're down on the month. So it's been all over the place despite a lot of volatility, despite what may seem like a strong momentum in the markets earlier in the week, and of course us pushing up to near all-time highs again. We are still down on the month of December so far. We were basically flat as of my yesterday's update, and of course after today's brutal sell-off, we are now finally down, I think a little bit over 1%. In the month of December for the S&P 500. So we were down a little bit over 1% on the day. The S&P 500 closing in at just shy of 6,000. Once again, the NASDAQ a little bit over 1.5% down, and the Dow Jones dropping back under 43,000 on the day. I've got some very interesting data for all of you that I essentially took some time to compile it because I already had a lot of the return profile for the S&P 500 over the last 200 years, so going back 1825, and as we are now entering 2025, I figured I'd do a very detailed analysis on what these numbers actually mean so that we can better prepare for 2025 as we are closing in on the 200th year of the S&P 500. This right here is, of course, the market's heat map. Looks pretty brutal. Tesla down almost 5%, Nvidia down over 2%, Apple, Microsoft, Google, Meta, all these stocks, of course, there's a lot of red, the sea of red in the market. My portfolio was down a little bit over 14,000. And the total gain, I was really hoping that I finish close to $250,000 of total gain in the year. But of course, markets had different plans, and I am at 231,000 with, of course, the daily loss sitting at just over $14,000 thanks to Tesla, thanks to VUG, thanks to the semiconductor industry, and overall $600 billion worth of market cap erased in the market, of which Magnificent Seven putting in a nice little contribution of 50% of $336 billion. And top 10 coming in at $364 billion, and the big three, and Apple was so close to a $4 trillion market cap, selling off at over $178 billion, among which the biggest losers, of course, was your Mag 7, Tesla, Nvidia, Microsoft, Apple, Google, Amazon, and Meta platforms, all of which dropping quite aggressively, with Tesla leading the way, $78 billion loss, and we got Nvidia $70 billion, Microsoft $56 billion, Apple $51 billion. It was actually very close to $4 trillion, but then of course dropping back down to 3.9. We're once again about $100 billion away for Apple's milestone of $4 trillion. Now, before we move any further, and these were the stocks where the liquidity kind of went to: Pepsi, Mondelez, we got Starbucks, FedEx, Occidental, Pfizer, the Hershey's Group, a lot of that money kind of flooding a little bit into these companies. Yields are certainly a big influence on where the markets are headed next, because if you come over to the 10-year treasuries, we are now sitting at well over 4.6%, 4.629% to be precise. And as I discussed in my yesterday's market update, where yields are going crazy, once again, this is certainly acting as a very big influence on where growth stocks actually end up going. Now, this was also, in my opinion, a little bit of profit taking. So today was a mixture of both profit taking, a little bit of year-end tax loss harvesting, a little bit of year-end rebalancing, as well as the treasury yields pushing higher, spooking the market. On top of that, you layer the idea of fewer rate cuts in 2025 with expectations of potentially inflation also increasing back up, and you've got a recipe for a day like today where the markets were certainly selling off very aggressively. And what's interesting with the FedWatch tool is that there is now this column that's opened up, right? This is the column for increasing interest rates by the Federal Reserve. So right now we're sitting right here. We're at 4.25 and 4.5%. And there is an 89% probability that the Federal Reserve stays there in January. There's a 49% probability that the Federal Reserve stays there in March. And then the first cut the market is pricing in for is going to come in May. And May 7th, they're expecting about a 48% probability that we're going to see a 25 basis point cut. And up until a few hours ago, this was actually the only cut the market was pricing in. And so now we are expecting by December next year, so 1 year from now, the Federal Reserve is going to cut again another 25 basis points for a total of 2 rate cuts in 2025 or 50 basis points. However, that is of course subject to change. 1 year out is a long way out. A lot of things are going to happen in the next 1 year with inflation and interest rates and economic growth. And so a lot of these expectations will indeed change. But that being said, the markets are certainly very concerned about where inflation is going to go. Are we on the rise for inflation, or are we going to see inflation stay where it is or trend lower? A lot of that is really what's going to dictate where interest rates end up going. And the fact that there is even the idea that interest rates could get hiked again, like this column opening up, just goes to show the markets are very uncertain about where inflation is going. And of course, the yields pushing higher certainly does suggest for a very strong economic growth or higher inflation or both. And so it's going to be a very, very interesting year. Time will tell what 2025 has in store for us. Now, before we move forward into these spreadsheet, which I've compiled for all of you, which is very useful data, make sure that you drop a like and subscribe to the channel. And also do share this video with your friends, family, other traders, investors, which I think it can be very useful for them. And also do check out the links down below if you're interested in joining us. There is a 16% annual discount available until the end of this month, so just 3 more days left if you are interested in taking advantage and joining our MoneyVest community, getting access to all the trade alerts, options portfolio, long-term investment portfolios, private members only videos, weekly updates, as well as all the trade alerts. And you can also engage with thousands of traders and investors on our Discord. So you can learn, you can, find support for your journey of investing and trading, and we're all here to support you. So if you have any questions, please feel free to reach out, and I'm more than happy to help. So link's going to be down below. Again, that 16% annual discount expires at the end of this month, so take advantage of it while it's still here. So this right here is a spreadsheet of all yearly returns of the S&P 500, so all the annual returns. So I went back as far as 1825. That's exactly how we have this bell curve, which essentially gives us an idea of all the returns, the return profile for the S&P 500. And you'll notice, of course, between 0 and 10% is majority of those years, the S&P 500 has given us a return of between 0 and 10%. Now, what I did was basically try to understand how many years the S&P 500 has given us a return, an annual return of more than 20%, and then a return of more than 25%. So because the reason I do this is that if you take a look at the last 2 years, 2023 and 2024 has been incredibly strong. We are up over 25% so far this year. In 2023, we were up over 26%. So those are 2 back-to-back 25% plus years for the S&P 500. So I really wanted to go back and check that if we are up 2 consecutive years over 25%, what does year 3 look like? And this right here is what I found. So I essentially broke it down between 2 different types of analysis. Number 1, every time the S&P 500 is up 20% or more for 2 consecutive years, what is the return probability for the year 3, which is what 2025 will be. That'll be year 3 because we're now entering year 3, 2025, after having 2 consecutive very strong years. And then the second was if we are up over 25% or more, which is exactly where we are right now. But the reason why I did 20% is because we don't know what the next couple trading days might look like, 30th and 31st. We might still sell off in the S&P 500, and that return could really drop from 25 something percent. Right now, you can see 25.83 down here can drop down to like under 25%. So I want to have an idea of both 20% or more and 25% or more. So this is what I was able to find. There have been over 15 instances in the last 200 years. The markets were up over 20% for 2 consecutive years in a row, of which year 3 was positive 10 out of 15 times. 10. So if you do the simple math, there is a 66% probability, about 2/3 of the time, year 3 was positive by an average of 6%. Average of 6.2% to be precise. So that is to say that if the S&P 500 over the next couple of trading days that are left this year is able to still close above 20%, which in my opinion, it might, because we have 2 trading days, we're already up over 25%. So if we're able to close over 20%, that'll be 2 consecutive years of over 20% gains. And now year 3, which is 2025, puts us at a 66%, 2/3 of the probability that we're going to be up by an average of 6%. Of course, this is nowhere near close to what the last couple of years have been, but that's for a reason, because the last couple of years have been very strong, and it's only obvious that year 3 is not going to live up to those last couple of years, and it's actually going to be a lot lower. 6%, I'll take it. I'll take it after 2 very strong years of 25, 26%. 6%, I'll take it. If it's up over 25%, so if the markets were to close today for the year, that's over 25% or more for 2 consecutive years, the probability jumps that year 3 is actually going to be, probability-wise, going to be green, 71% probability that we're going to have a positive year, 2025, but it's going to be average about 2.5%. So it's a lot less. Probability for success is higher, but the return profile is a little bit lower. And even 2.5%, like, to be honest, like, considering the last couple of years and how strong they've been, even 2.5%, I'll take it. I think I wouldn't have anything to complain for 2.5%. However, of course, this is very circumstantial. Every year is going to be different. Every year is going to have its own challenges and own upsides and downsides. So just take it with a grain of salt. But I figured I'd do a little bit of this analysis to help you better understand the consistency of these returns, and they most likely, in most circumstances, come down after 2 blockbuster years like what we're seeing in 2023 and 2024. So that's about that. And then coming back over to some of the market updates here, the MoneyVest index is now sitting at 3.06 again. We are in the neutral zone as volatility also did spike. So if you come over to the VIX, sitting at just a little bit under 16 right now, if I'm not mistaken. So 15.94, 15.95. It was up a little bit over 8%, getting back up to the 38th percentile in the normal zone. And if you come over to the valuation, we're sitting at 24.47 as the S&P closed the week at 59.70. So coming over to the technical breakdown, now I would say that this kind of feels a little bit more like a lower high for the S&P 500. Of course, we had 3-4 very strong days, and then of course selling right back down. So this right here will turn into a resistance, but you could argue that this right here is a resistance for the S&P 500 or a new all-time high, and this right here could be argued as a little bit of a lower high. If you come over to the 30-minute time frame, you can perhaps see it a little bit better that we weren't able to get up to levels like 6,000 or 6,100, but instead got rejected right there and then sold off very aggressively. And this could also still put us back on the map for a potential head and shoulders, a little bit more of a tilted head and shoulders, but left shoulder, head, and a potential right shoulder formation with a neckline sitting at 58.65. So we're like not out of the woods yet. Yes, there is a lot of back and forth. There's a lot of indecision. We are practically at the same price as we were during my birthday on November 7th. So we're really just been trading sideways. And it takes time to actually see the sideways action, right? Because you might see the markets are pushing up and then they give back all those gains and they come back to the same price as they were, let's say a month ago. And before you know it, we're now trading sideways, right? So we're trading in a consolidated pattern where support levels at 58.65 with a very strong resistance at 6,000. So that's really what we need to pay attention to, is some of these key levels and whether they break down or not. For NASDAQ, you can see we got perfectly tagged at this higher low. Buyers really did step in. However, we've got a much stronger area of support right about here. It's going to be sitting roughly at around 19,300, resistance all the way up to 20,000 for the NASDAQ. So again, a little bit of a lower high. There is some weakness, in my opinion, that's brewing in this market. There could be a beginning of a potential shift in the overall direction, and that will be identified by these weaknesses like the lower high, like the lower low, like the overall price action. And right now, whatever I'm seeing, I'm not super confident, whether we're going to be able to hit new all-time highs again, or whether that's going to take a little bit longer. And I think a part of that problem, of course, is profit taking, as I said, tax loss harvesting, rebalancing, then of course the yields pushing higher, putting more pressure on equities and more specifically the growth areas of equities. And, when the markets are so concentrated, right? When the markets are so narrow, as you can see over here, from the charts that I showed you guys for market breadth, can't seem to find it right now. For market breadth, if you guys remember, I showed you guys some charts. Let me see if I can find it. Comparable. I will pull it up and I will share it in the Discord. But if you guys remember, I showed you guys the market breadth, and that of course is very weak. It's a very weak profile, and that just goes to show that it's a very narrow and concentrated rally, which is primarily being driven by Magnificent Seven. So if Mag 7 stocks sell off the way they did today, you better believe it. There's going to be a lot of momentum to the downside for the entire market. Coming over to Apple, and Apple here just giving back on some of those gains. It wasn't able to close above 2% on the day here, hence was not able to set the record since 2010 when it was going to be up 6 weeks in a row. But instead, this week we are up 43 basis points. Still 6 consecutive weeks of green in a row, but not over 2% as we saw over here. As you can see, last 5 weeks, very strong for Apple. Tesla, on the other hand, we also talked about how there is a little bit of that uncertainty around the price action, considering the last week's candle was, somewhat scary. And of course, this week there was a lot of consolidation. It's still holding up. It's still holding up those support levels, but the question is for how long. January 20th is right around the corner. Maybe that can spark a little bit of optimism back into Tesla stock. We'll find out very soon. And of course, delivery numbers are coming out for Tesla for the fourth quarter. That's going to be a huge catalyst for the company. So support level is going to stay put inside this green rectangle for Tesla right now. And of course, resistance all the way up to as much as 459, 450s to as much as 487, 485. Talking about Amazon here consolidating sideways a lot. Resistance is going to stay put roughly here at 232. Support at $216 for Amazon as well. Coming over to Nvidia, a lot of consolidation sideways, down about 2%, coming back down to that support. It's really been trading sideways with that resistance staying put right about here, and a lot of support right there. And that's the range within which Nvidia has been trading at right now. Advanced Micro Devices, I've still yet to do a video on AMD. I know there's a lot of interest. There's a lot of questions around Advanced Micro Devices stock. Lower highs and lower lows. Very strong support sitting right here of 115, 116. Resistance is, of course, where it's battling right now inside this red rectangle right now for Advanced Micro Devices, all the way up to as much as $142 for AMD as well. Coming over to Meta Platforms, I'm actually going to be doing an analysis on Magnificent 7 right now only, and then for other stocks, we'll do a weekend update going over some of the other stocks. And of course, we also do have our year-end wrap-up for 2024, and then of course planning for 2025. So again, if you want to get access to our private live stream, link's going to be down below. We'd love to have you on board for that as well. And with this right here, Meta, very nice higher highs and higher lows. Support level is going to stay put down at 540. Battling through the resistance at $600 right now, just hovering in and around those levels at the moment. And of course, Google and Microsoft also selling off, consolidating sideways. Resistance is going to stay put at $202. Support level at 183. A lot of consolidation sideways for Google as well. Microsoft starting to break down after of course having a nice little breakout. It's now starting to finally break down again, and it's starting to trade below this level. And the next support level is going to be down in the low 400s again, and this will turn into a resistance for Microsoft since it's trading below that level at the moment at 430, 441. And so finally, we got Meta, Google, Microsoft, Tesla, Amazon, Apple. I think that's all of it. Nvidia. So I'm going to be doing a separate analysis on the other stocks that we usually cover on a weekend video. So that's going to be a more detailed analysis on a technical basis for those companies. So that's where we are. I mean, a little bit of a year-end sell-off, which is normal considering how stretched we were. Volatility spiking back up, yields are on the way up, and technology certainly struggling at the moment. And so be ready with cash. That's really what I'm telling myself, is to be prepared with some cash on the sidelines to take advantage of those deals if and when the markets do come down. And of course, the MoneyVest Index also triggers one of those buy signals again. I will be ready to take advantage. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. Again, link's going to be down below if you're interested in joining us. 16% annual discount that's available until the end of this month. A few more days left, and you get access to everything: options portfolio updates, long-term portfolio updates, as well as all the trade alerts and Discord access, MoneyVest website access. So link's going to be down below. We'd love to have you on board. And as always, happy investing. I'll see you all in the next video.